All right. Today's Wednesday, the 13th of August, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. We're going to talk about a few things. The Nvidia affair, of course. It is the biggest topic right now in business. And we got an interview by Scott Bessent today, and it was an absolute disaster. And of course, we're going to look at the market data because we have a market that is prone to a really nearing accident. So without further ado, folks, let's just dive right into it here. And I'm going to remind you with the old Scott Bessent when he was rational. He was a maverick. Take a look.
You have a note out right now talking about a precarious equilibrium in the economy. What makes that precarious?
Well, look, now I've been doing this 35 years now, and the U.S. economy, in my mind, is starting to look like an emerging market economy that, or every kind of emerging market blow up that I've seen in my career. And that is you have rise in asset prices. So in the U.S., stocks and housing, that is fueling consumption by the top 10 or 20% of households. Top 10 or 20% of households or account for more than 50% of U.S. consumption. Then below that, the rise in asset prices being fueled by a 7% to GDP budget deficit, biggest we've ever had when it's not a war, not a recession. And then the third leg of that is Janet Yellen has moved the quarterly refunding to much shorter term debt, which has had the effect of suppressing interest rates. So you've got, I call it the three-body problem after the Chinese science fiction book and the famous math problem. So we don't know which one of those could go first. But it's one of these that if the stock market were to go down, then it could create a gap in consumer spending.
So again, hedge fund manager Scott Bessent diagnosed the problem with perfection. The stuff that we're seeing in the United States right now is similar to the preceding conditions, if you may. In emerging markets, when we had bubbles and massive crashes, and you can go back to the Japanese bubble in the 1980s, you can go to recent bubbles that we had, even in Venezuela, you'll see the same conditions. You have an asset bubble where houses, stocks, they're just going crazy with no explanation, with no justification, with no fundamentals at all. At the same time, all of this is financed by huge budget deficits. That's another check mark. And the third one is the manipulation of the yield curve to prevent yields from spiking higher because of this inherent inflation that's going on in the economy. So he knew what the problem is, but right now it seems that he's forgotten all about it. We got the new Scott Bessent, and the new Scott Bessent says, I don't see a problem. We're doing better than ever before, and adding tariffs on top of the problem and expanding the budget deficit bigger than 2024 and continuing to pump this insane bubble, asset bubble in housing and the stock market. Oh yeah, I don't see any problem with that. Now let me tell you something, because a lot of you don't know this, but I got to meet Scott Bessent twice. I met him in hedge fund conferences in Las Vegas, in New York, and everybody pointed to that guy and said, you got to talk to Scott Bessent, one of the smartest guys ever. Everybody wanted to know what he's buying, what he's shorting. So the guy's not stupid. He's actually quite legendary in the world of hedge funds. He was mentored by Stanley Druckenmiller. And I would say Stanley Druckenmiller is perhaps the greatest investor in history, maybe second to Warren Buffett, because he never had a losing year. Never lost money. Not to mention, of course, that Scott Bessent was one of the traders under George Soros. I don't know if Trump really knew that when he hired him, that he used to work for evil George Soros. Anyhow, the greatest trade in history when George Soros shorted the British pound. Guess who was involved in all of that? It was Scott Bessent. So he's one of the smartest guys in the room. He knows finance, and he knows how to bet on stocks and how to short and all of that. Why is he acting so stupid right now? He knows the tariff policy is wrong. He knows the deficit policy is wrong. He knows what we're doing with Nvidia right now is wrong. I mean, think about this Nvidia affair. This is what we're going to call it, the Nvidia affair. You heard it here first, because they're going to talk about it in the Wall Street Journal and CNBC in the national news pretty soon. The Nvidia affair, it's a big deal. A lot of you say, Marv, you're talking about politics, you're talking about this and that. I don't like it. You don't like what? The most important topic in business today? Should we talk about cooking recipes here? For the first time in American history, we have an administration that gets involved in a private business and says, we're going to take a cut in exchange for you to be allowed to do business in a certain country. There are a lot of ramifications to that. In the moment the government gets involved in all of this, not to mention, of course, the espionage angle to this Nvidia affair story, you begin to damage the credibility of the company. And for all of the reasons that we discussed that the AI bubble could go bust from, and we talked about disruption, we talked about competition, we talked about the loss of the pricing advantage. But out of all of the reasons, the one that could be unexpected would be this angle, that Nvidia loses credibility because Nvidia is now being used and weaponized by the US government and US intelligence. Check out the story that we got just after the bell today. US embeds trackers in AI chip shipments to catch divergence to China. So when Nvidia said there's no bugs and the administration denied they were bugging the chips, well, now we're going to lose a lot of credibility, and the Chinese know that. And this is why they're warning their companies, do not use Nvidia's chips. Now, listen to this. The Chinese Foreign Ministry said it was not aware of the matter of the trackers right now that we're talking about. Supermicro said in a statement that it does not disclose its, quote, security practices and policies in place to protect our worldwide operations, partners, and customers, end quote. It declined to comment on any tracking actions by U.S. authorities. Now, Dell also said that it's not aware of a U.S. government initiative to place trackers in its product shipments. Nvidia said that we do not install secret tracking devices in our products. We also got AMD, who did not answer a request for comment. So all of US companies now losing legitimacy. This whole thing could be a big espionage project. The data centers, the chips, the equipment. This is a big story, and it has to be covered, because the government can deny all they want if there is a reputation damage. I know we're a little bit arrogant in this country right here. We think, oh, there is no alternative to Nvidia's chips. They're going to have to buy it either way. Well, guess what? Countries are not stupid anymore. They got skills, they got resources. And if we begin to diverge towards sort of a nationalist approach in AI development, where each country has to develop their own in-house to prevent espionage by other governments, other countries, and other companies, then the bubble busts right away, because you're limiting the market share of these companies. You're limiting the pricing advantage of these companies, including Nvidia. And today, Scott Bessent was in an interview with Bloomberg, and he was asked about all of this. The Chinese saying that, hey, don't use Nvidia chips. So all of this stuff about making the deal with Nvidia and AMD, the 15%, and the espionage accusations. What if at the end of the day, China doesn't want the chips? Take a listen to what he said.
Well, we have exclusive reporting that Beijing is now sending out letters to firms saying, actually shrug off those H20 and use our domestic champions. Is this something you might discuss with your counterpart?
Sure, we can discuss that, but it also tells me that they are worried about the Nvidia chips becoming the standard in China. Look, Nvidia is an incredible product. A lot of the technology in China is, they're piggybacking, and I'll use piggybacking as a kind word for acquiring our technology.
Do you mean stealing?
Your words. And yes, that's what I mean. And the Nvidia, Jensen Huang just stays years ahead of them.
Criticism came from the Wall Street Journal editorial board, though, about this new unique policy. They say it's a step toward government control of private business. Are you concerned? Some of these policies are starting to look like the country you're actually trying to de-risk from. Central planning, basically, out of the oval.
No, not at all. Because where we got was with this unfettered trade, we did not have secure trade or fair trade, and so now we are trying to make it secure. So you don't want to. We're not sending out the highest level chips, and we don't want to sell everything to everybody. So there is a need for intervention, and the Wall Street Journal just let her rip. Kind of bunch of grumpy old men over there. I was with them yesterday.
So again, he says that the Wall Street Journal, a bunch of grumpy old men. But at the end of the day, what they're saying is true. We got interference by the federal government on private business, and it could damage the reputation of these businesses globally. Now, have we done that before from the espionage angle, that the CIA or the government implanted devices before in IBM products or Lockheed Martin jets that we sold to other countries? Yes, we've been doing this for years. But you gotta understand, this is not the Cold War era. So a lot of these countries know how to detect these devices, and once we lose credibility, there is no repair to that. The new angle that we've never seen before is the government actually taking a cut from a private business revenue to allow them in exchange, to allow them to do business in a certain country. That never happened before. So look, the Nvidia affair is a big deal, and it's going to be, the story is just beginning here. We're just scratching the surface. It's going to heat up in the next few days. But the interview with Scott Bessent was really interesting because he talked about a lot of other stuff too. For example, we're talking about the tariffs right now. So the government is boasting about the tariffs. Hey, we're going to raise $300 billion. And the question right now, what are you going to do with that tariff? Are you going to give us rebates? Are you going to pay back the debt, which is going to be just a little tiny dent, a drop in the bucket, given the degree of the deficit? Well, here's Scott Bessent's answer.
This is going to raise some revenue. What do you plan to do with it?
Pay down the debt.
It's all going to go to pay down the debt, because we have heard some stories about the money going back to consumers, going back to citizens of the United States taxpayers.
Well, President Trump's talked about that, and look, the bottom 50% of wage earners in the one big beautiful bill are getting a lot of money back. No tax on tips, no tax on overtime, no tax on Social Security. Auto loans are going to be tax deductible. So I think if we could make a substantial dent in the debt repayment, then we could talk about a program like that.
So again, this is a load of shit because, I mean, look at what they've done to Las Vegas. You're giving me tax cuts on tips. You're giving with one hand, you're stealing with three others. Who's going to tip the workers in Las Vegas? Yeah, sure, nice. We're going to get tax cuts on the tips. But where did the tippers go? Nobody's visiting. People are losing their jobs. You give them the tax cuts for tips, it's not useful anymore. The big beautiful bill was tax cuts for the rich and the wealthy and the corporations. And if you poors, the middle class, you know, the bum class that the oligarchy doesn't care about, if you think you're going to get some taste of that tariff revenue, forget about it. You're not going to get shit because we have a deficit problem and every penny's going to go either in, who knows, corrupt deals and payouts. But mostly it's going to go in paying out the debt and the deficit because we have a huge hole now. And speaking of, by the way, listen to the audacity of Scott Bessent when he talks about the deficit. Take a look.
Do you see more reason then to pare back on 30-year issuance with all this in mind? And this is a change again for you now in the seat as you look at these developments and rethink things. How are your thoughts on that matter evolving?
Yeah, they are evolving, and we'll see where things go. I do think as we bring down this big deficit that we inherited.
What's he talking about, inherited, the deficit? No. You've expanded the deficit like we've never seen before. You've added $5 trillion to the debt ceiling. So how could he talk about, oh, we inherited the deficit? You should have done something about it. Sure, we know that the previous administration increased the deficit like mad. But the premise behind electing this administration was they're going to fix that. You made it worse. And then you have the audacity to come here and say, oh, we just inherited the deficit, as if we're just dumb people. We don't know how to do research and know who's actually responsible for expanding the deficit. Let's continue here because there is another question of, okay, we're getting tariffs right now. We're seeing a little bit of inflation showing up because of these tariffs, but not much. Not at an alarming level yet. So how does Scott Bessent see the tariffs and who's going to be responsible at the end of the day for paying them? Take a look.
You've heard the debate playing out on Wall Street now for a number of months. Who's going to pay the tariffs? By definition, the importer will pay the tariff. The more important question here is who absorbs the costs, whether it's the foreign supplier, whether it's the domestic company here in the United States, or the end consumer. We got some data yesterday. You've seen it. We've all looked at it. Limited tariff pass-through relative to what was expected. Because of that, a lot of people are suggesting that maybe companies are absorbing costs in a way we didn't anticipate. Perhaps the pass-through will be more muted in the future. Are you comfortable with where things are now, or do you think things might rebalance in the months to come?
Jonathan, I think your framing there is exactly right, because that, obviously the tariff itself is paid at the port, but what if the producer in the other country has lowered their price the 10, 15, 20% so that there is no price change with the tariff? And obviously our largest trade deficit is with China, and China does not have the same profit objective that other Western democracies do. So that is an employment agency, and my view has been that they would continue to eat the tariffs. They are doing that. So I think what we've seen is likely to continue happening. I also think there are probably a lot of corporate margins that got very fat during COVID, and now we're seeing a return to normal pre-COVID margins.
Again, he's speaking with both sides of the mouth, contradicting himself, which means that he's bullshitting. He began the answer with saying that, China, the factories over in China, Malaysia, Indonesia, Taiwan, Vietnam, whatever, they're going to give the importer a discount to account for the tariffs. So yeah, sure, the importer is going to pay the tariff, but at the end of the day, the importer is getting a discount from overseas, so they're not going to pass the extra cost because there is no extra cost down to the consumer. Sounds like bullshit. There is no data that supports that at all. There's no data that says the Chinese factories are reducing their prices by 20-30% to accommodate for the tariffs. And he actually admits all of that by saying, we're beginning to see the corporate margins, the fat corporate margins from COVID beginning to shrink as they continue to eat the tariff. So which one is it, Scott Bessent? Is the Chinese factory eating the tariff, or is it the U.S. company? And this is why we see reduction in margins. What do you think will happen to the stock market, at least the stocks of these companies, when we see reduction in their margins? I know, folks, that we're trading at all-time highs, but that's a handful of names responsible for that. We have seen disasters in terms of the reactions after earnings for a lot of companies going down 15, 20, 30% as we begin to realize that their margins are going to be much lower as they begin to eat the tariff. We are right now in the honeymoon period of this tariff policy. I'll give you an example from my own business. I'm not really exposed to the tariff by much, but I got a bar. We serve some European beer, and we get them from Poland, from Czech Republic, from Germany. I get them from a distributor, a U.S. company. They import the beer, and then they send it to me. The European companies, the beer exporters, they're not reducing the price on the importer. The importer is eating the tariff right now. They're not passing it down to me because they don't want to lose business right now. And making these decisions of increasing prices takes a lot of time, and it's not easy because the moment you raise your prices, you lose business. If the importer says, distributor says, hey, we're going to increase the price on you by 15%, 20%, I might say, you know what, looking at my books, I need to reduce my inventory of European beer either way because I'm not seeing customers coming in and they lose business. So it's better for them to eat it right now. This dynamic is not sustainable though, because at some point this reduction in margins is going to be more noticeable. So either the importer, in this case the distributor, the US-based company, either they're going to pass the extra cost down to me, the customer, or they're going to have to cut their own expenses, meaning that they have to fire employees so they can absorb the tariff. This is the dynamic that nobody's talking about, but you're going to begin to see in the next few months. Now add to that, by the way, the risk of inflation, and now you have this madness of asking for severe rate cuts amidst an inflation risk. So now either way, with the tariff policy, with the tariff being passed down to the consumer or not, the consumer is going to get screwed either way because inflation is going to go higher with the reduction of interest rates amidst the conditions that Scott Bessent warned us about last year. Asset prices all-time highs, deficits expanding, manipulation of the bond yields and the curve. On top of that, you want to cut rates and manipulate those curves even more and threaten inflation to come back in the picture. Listen to Scott Bessent's answer when he was asked about the rate cuts. He says the justification for the 50 basis points rate cuts because the Fed would have done 25 bips had the employment data, the reductions that we got lately, were actually released in the previous two reports. Take a look.
Well, I think what we could see is that, first of all, what if the BLS data had been the higher quality and we'd had those numbers, Jonathan? So if we'd seen those numbers in May, in June, I suspect we could have had rate cuts in June and July. So that tells me that there's a very good chance of a 50 basis point rate cut. And I think President Trump is very good at giving these nicknames. And I think the reason that the Jay Powell gets the nickname too late is because he wants to go into a series of rate hikes. He's not willing. He's not Alan Greenspan, who was very forward thinking. They try to be more data driven, which I think is a mistake, because I think we are going back into an economy like we had in the 90s. So, it's just very old fashioned thinking, but I do think we could go into a series of rate cuts here, starting with a 50 basis point rate cut in September.
So pay attention now, because he says the justification for interest rate cuts is weaker jobs data. I don't know about the reporters that we have in Bloomberg, CNBC, all over the place. They don't ask the tough questions because they want to schmooze these personalities. Otherwise, they might get offended and not do interviews with them anymore. But this chick right here hit him really hard. She caught him with one he did not see coming. Take a look.
A 50 basis rate cut in September. Does that signal that the economy, though, is not doing well?
That signals that there's an adjustment and the rates are too constrictive. If you look at any model that if you...
So Bessent, he doesn't know what to say. He got caught. Yeah, of course, you're cutting rates as if it is an emergency. The only reason to do that if there is an emergency. And maybe you're admitting that underneath it all, we're losing a lot of jobs. A lot more than we have been told. But we all know the reason. We all know why they want these big rate cuts, even without the justifications. They want the rate cuts just to manipulate asset prices higher. They want the stock market to go bananas and increase the risk of another bubble deflating. They want asset prices, homes, land to go significantly higher because of these rate cuts. They want inflation. That's the bottom line. Inflation wrecks the poor, but inflation is so good for the rich and the 1%. That's what they want. That's what the oligarchy wants. But hey, Mav, what if they cut rates by 50 bips and then we see the long end of the yield curve, the 30-year bond yield moving significantly higher above 5%, 5.5%. Mortgage rates go higher and it backfires. Rest assured, Scott Bessent got a remedy to all of this. Take a look.
What's the usefulness of issuing a 30-year bond when it feels like at the moment we're outsourcing borrowing costs to what happens in Japan, what might happen in the UK, what happens in Europe? What's the value of issuing that?
That's a great question, Jonathan. And look, we are committed to keeping inflation expectations low, and this is a global phenomenon, whether it's the 10 or the 30. The U.S. 10-year is one of the few 10 years where the yield is down on the year. So that tells me that there's credibility from Treasury, credibility from Fed, that the inflation expectations are well anchored, but there's definitely leakage from the Japanese have an inflation problem. I've spoken to Governor Ueda. My opinion, not his, they're behind the curve, so they're going to be hiking. And they need to get their inflation problem under control. In Germany, we saw a substantial spike in German rates in the past week also. So, our 30-year is getting dragged along with that. We've been refilling the Treasury General account, which during the debt ceiling standoff got run down, and we're doing that with short-term bills.
Okay, so in other words, you're going to continue the same policy of Janet Yellen. He's even doubling down on the policy of the manipulation of the yield curve by Janet Yellen, of increasing issuance in the short-term bonds and reducing the size of the auctions at the long end of the yield curve to try to muff and mask the reality of what's going on in the economy. I mean, you got to remember, I showed you in the interview in the beginning, he was criticizing Janet Yellen for doing this. Now he's following the same policy, even doubling down on it. But here's the problem. I think the bond vigilantes are not going to leave him alone. I think they're going to hit pretty hard. And the next thing you know, we talked about Trump, of course, when you begin to see the polls. By the way, the polls are horrendous right now. Trump won against Kamala Harris because of the inflation issue, because the Democrats were gaslighting everybody. Oh, everything is fine. You're just imagining. Inflation is just a Trumpian propaganda. Everybody knew that's bullshit. Everybody knows shopping at the grocery store, that's bullshit. So they voted Trump. And Trump now stabbed everybody in the back. And hence the polls right now are absolutely disastrous for this administration. At the end of the day, we have to admit that both parties don't give a flying fuck about us. Both parties want inflation because it makes their donors, their Johns, richer. Take a look at this poll.
Really, a huge piece of why the president was elected was to get a handle on cost of living. So how do Americans feel like he's doing?
Let me just say, this is an abject disaster. Abject disaster for the President of the United States. You mentioned it, Jessica. Look, voters on Trump and inflation. He won the 2024 election because he was more entrusted on inflation than Kamala Harris was, led by a margin of 9 points. Look at where his net approval stands today, though, on inflation. My goodness gracious. Into the gutter we go, underwater we go. He's 25 points underwater. My goodness gracious. That is where the Little Mermaid is, and he is matching the Little Mermaid. That's how far underwater he is on the issue that got him elected. He led on by 9 points on it last year, and now he's 25 points underwater. As I said, this is a complete and total disaster for the President of the United States.
So let's look ahead to 2026 when a lot of all the House Republicans, some senators going to be on the ballot. How is that shaping up?
Yeah, if Republicans in Congress think that they can escape the wrath of the voters when it comes to inflation, I have a bit of a rude awakening for them. Trust which party more on inflation? You go back to the 2022 midterms, look at this. Republicans led by 13 points on which party was more trusted in inflation. Look at where we are now, nearly a 15-point shift in the Democrats' direction. It's within the margin of error, but the Democrats up by a point. This just looks totally different from where we were back in 2022 when, of course, Republicans took back the House. That's what Democrats are trying to do this time around, looking much better for them. The bottom line is the wrath that the voters feel for Donald Trump and inflation is transferring over to House Republicans and now Democrats, although it's a small lead, a big difference from where we were back in October of 2022. Very much the reverse of where we were just 3 years ago.
Yeah, and so how do voters feel about inflation in terms of where it ranked and what kind of priority it is for them?
Right. So we started off this segment by saying that inflation was the reason that Donald Trump was elected. It was the most important issue for the voters back last year at this point. And look at where we are today. What is the top issue for you right now? It's a runaway. It's inflation. It's 34% compared to the economy, which is basically very similar at 16%, Medicare and Social Security at 14%. But the bottom line is voters in poll after poll after poll say that Donald Trump has taken his eye off the ball, off the big issue of the day, which is inflation, and that is why Donald Trump is way underwater on this issue, and it's why Democrats have caught up to Republicans on the all-important issue of inflation. I can guarantee you this, Jessica, if these numbers look right now like they do, or will look on Election Day 2026, there is no way on God's green earth that Republicans can hold on to the House of Representatives. These numbers, as I said, an abject disaster.
The last one. Let's talk about this upcoming meeting with Trump and Putin in Alaska. Scott Bessent was asked about all of this, and he gave a bullshit answer of, we're going to tariff India even more. And then again, God bless her, this reporter, I don't know her name, forgot it, but she caught him with another one. Take a look.
I think everyone has been frustrated with President Putin. We expected that he would come to the table in a more fulsome way. It looks like he may be ready to negotiate, and we've put secondary tariffs on the Indians for buying Russian oil. And I could see if things don't go well, then sanctions or secondary tariffs could go up.
What about China? They're the main purchasers of Russian crude.
Again, I'm not going to get ahead of the president, but the president is the best at creating leverage for himself, and he will make it clear to President Putin that all options are on the table.
Anyhow, let's add more color to this conversation by revisiting the market activities today, beginning with the closing of the indices. And here we go. We're going to look at all of the indices together because it is important to illustrate for you the themes looking at different indices. So the Dow represents the risk-off rotation. When you see the value names going higher, that's when the Dow begins to outperform. You got your NASDAQ, the S&P 500, these are technology ETFs, pretty much. These are the AI ETFs, pretty much. You got Nvidia, you got Microsoft, 15%. These two names, 15% of the entirety of the S&P 500. Anything wrong that happens to these two names, and America's retirees are poof gone. And then you have the Russell 2000 small caps. That's more impacted by yields. So if we have expectations of rate cuts, the Russell 2000 love rate cuts. So what you see today with the Dow Jones outperforming the big indices, we see the NASDAQ and the S&P lagging, you know that we had a risk-off rotation of value out of technology. When you see Russell 2000 heading higher, then you know that expectations of rate cuts have been amplified. And the reason is Scott Bessent coming out today saying, no, we're asking for 50 now. So you see the Russell 2000 leading the pack with gains of about 2% for the day, the Dow Jones about 1%, and of course NASDAQ and the S&P positive but lagging behind. If we look at the sectors, here it is. You got the value sectors, healthcare, cyclicals, metals, real estate, energy leading the way to the upside. And then you have defensives, which is a lot of value in defensives, but we have certain names that went down big, so they impacted the sector negatively. We have comm services, technology at the bottom of the pack, so it's clear risk-off rotation. I don't know if it's going to last or not, but this is the theme for the day. Now, if you look at the breadth, another day of a really good breadth for the NYSE, 80% advancing, 19% declining. The NASDAQ, 70% advancing, 27% declining. So we anticipate for the market maker to win, because they always win. The house always wins at the end of the day. They have to give us a really negative day, either tomorrow or by the end of the week. And if it is tomorrow, then what is the catalyst? It has to be the PPI coming out as a shock. If it happens Friday, it would be because of a gamma phenomenon options market. I will talk about that in a minute. But let's do the heat map right away. You can see the risk on, the risk off rotation. You got Meta in the red, Google, Oracle, Microsoft, the chip names, Nvidia, AVGO, all heading down. The exception is Amazon for now. We see a rebound in the laggards in software, but definitely there was a sort of a risk-off rotation, booking profits by the professionals. Why do we say that? Because you look at the big names. For example, Nvidia, JP Morgan, those are being sold. But then you look at the names that are more impacted by the retail investor, like AMD, for example, not pulling back along with Nvidia. So the risk on to risk off rotation that took place today was coming from the money managers, the professional, the institutional managers, not the retail investors. And the migration was toward value. So you look at big pharma, you look at a lot of the healthcare names were higher, a lot of the value names and industrials were higher. The classic utilities were higher, while the AI utilities like CEG and Vestra were down. You see buying of the dips in materials. That's where we see a lot of value. So long as the dollar continues to go down, we see energy again being bought. We see a lot of names in consumer defensives going higher, but you have Walmart, you have Kroger going down because of a piece of news that came from Amazon. So you see Amazon higher. Amazon is going to begin to deliver tomatoes and lettuce and stuff. So the market right now reads it as this is bad for Kroger, Walmart, Costco. I say good luck delivering perishables here in Las Vegas. Anyways, you see another theme here with the dollar going down. You see Alibaba. You see the Chinese names going higher. You also see names like Home Depot and the home builders, Lennar, D.R. Horton, going higher. But that's because of the assumption of rate cuts and interest rates going down. Now, if the PPI comes out hot, forget about it. They're going to go in the red again. We talked about a few names yesterday in the morning brief. We talked about the airliners like Delta Airlines and UAL. They're doing pretty good. We talked about a name like Berkshire Hathaway and the insurance companies like Allstate. Look at these gains right here. Berkshire Hathaway up about 1.5%. But you see the rest of the bankings led by the big banks like JP Morgan, Wells Fargo. Those are down. So you see the rotation from the, let's say, winners, overbought, overextended, to the laggards, like Berkshire Hathaway. Moving on to commodities, what do we see here? We're anticipating right now what's going to happen with number one, the PPI, because that is the last obstacle that we got for the dollar. If the PPI doesn't come out hard, then the dollar is going to collapse as we anticipate rate cuts now. So the dollar is going to go down. You're going to see a rush toward metals. You're going to see probably wheat going higher. You're probably going to see a lot of commodities moving higher. I would stick to gold, though, silver, and don't forget about the other foreign currencies. Bitcoin, cryptos, all of these are going to benefit if the dollar collapses from a tame PPI. But if the PPI comes out hot, forget about it. Dollar is going to rebound, and this map is going to look deeply in the red tomorrow. The other hurdle is the meeting that we have between Trump and Putin in Alaska. This is why you see a lot of investors holding off, not betting on gold, not betting on palladium, not betting on wheat, not betting on nat gas, not betting on crude oil. They've actually been selling and shorting these names for a little bit to de-risk. The assumption is that the meeting is going to come out with some sort of an agreement or a peace deal that allows the Russian oil to be sold in the market again, and natural gas to be sold in the market again, and Russian palladium and Russian wheat, Ukrainian wheat to be sold again in the wide market. I say all of this is just assumptions. I don't have high hopes from the meeting. I think it's going to be an understanding, but it's not going to result in something tangible or long-lasting. So you might see the phenomenon of sell the news, or sell the rumor rather, and then buy the news. In this case, dump crude oil ahead of the meeting. Here comes the meeting. Maybe it goes well, maybe it doesn't go well. At the end of the day, we buy the news because there is no tangible agreement. So we see crude oil rebounding after the meeting. That's my assumption right now. On to the big casino. What do we see here in the options market? We begin to see the volume catching up a little bit, but it is still concentrated in Apple, Tesla, AMD, and Nvidia. We see the volatility for Nvidia beginning to move a little higher. And if Nvidia drops again 1%, 2%, you're going to see the IV rank, the IV percentile heading higher. So this is the kind of conditions that I look for to construct a trade where I get paid to play. You buy the initial put, then you see the drop of 1%, 2%, then you sell the spread on it. You get paid for the trade, and then whatever the outcome is, you don't really care. The other one is Tesla, which is beginning to see some increase in the volatility, 1% in the IV percentile, about 1% of the IV rank. So we have another one here that we might do in Tesla before the end of the week. But there's nothing else that stands out looking at this list right here. Now, we continue to update you about the gamma exposure for the expiration date of Friday. That's the monthly expiration. So this is why we continue to watch this as it continues to be updated every day. So if you look at the gamma exposure, we have the calls at 645, huge number, but we still got the 650. So we can go, if there's no problem with the PPI, we can go to 650 really fast. If there is a problem with the PPI, we're probably going to go 640. If 640 is broken, that's when we see the gamma flip updated to. And that's when we can see a huge wave of selling. So one step at a time, because if that is the case, don't forget that we have still huge open interest in the puts at 625 and 630. So if there is a disappointment by the PPI and we see selling tomorrow, we might break 640 and head down to 630, even 625. So how do we deal with all of this, Mav? Here it is. This is the trade that I gave you today in Discord. All I did is I bought the 640 puts for tomorrow's expiration, just in case we have a hotter PPI. Then I bought the 650 calls. That's the gamma target for the end of the week for the calls, with the expiration date of the 15th, meaning Friday. And again, paid about 75, 80 cents a piece. I just need one big move one way or the other. I think we have a big gamma move coming one way or the other. And the trade is going to play out. We have a lot of room for maneuver. We can open spreads on it later on. We can exit one leg and keep the other. A lot of options to do, and I'm going to update you on them, of course, as soon as we get the reaction from the PPI tomorrow. Let's do the unusual activities, beginning with the bullish one. How about BMY, my boy, Bristol Myers? I like the name. I think that it's a value name. It's producing pretty good results, has pretty good cash flow, pretty good dividend, and somebody agrees with me here. They bought the 48 calls. They sold the 50, so it's a tight spread, bull call spread. But again, this is not a big mover, a high beta name. So it does make sense. And they bought them for the September 19th expiration. Right now, we're trading about 48, so they're not really far away from the money. They paid about $800,000 to enter this trade. Next, we have TMO, Thermo Fisher, another unusual name, value name that I do like. And here we have a series of buyers at the 540 calls. The expiration date is October 17th. Right now, we're trading well under 500 in Thermo Fisher. So they're expecting a big bounce here. I don't know if they know something that you and I don't, but this is a big trade coming out at $5 million a piece almost. So they spent about $16 million to enter these calls in Thermo Fisher. Something is cooking. And then we got the airliners. I talked about this yesterday. If they continue to jack the prices on the affluent consumer, and the affluent consumer doesn't give a shit because they want to look for credit card points, then these companies will get away with it. And the two companies that cater to the affluent consumer, UAL, United Airlines, and Delta Airlines. Let's begin with UAL. They bought the 105 and the 125 calls for the expiration date December 19, 2025. The name right now trading at about 100, so expectations of a big pop. They spent about a little over $10 million on this trade. Probably the same trader here doing the same trade on Delta Airlines, DAL. In this case, we're trading at about 59.5. They bought the 62.5 calls and the 72.5 calls. The expiration date is December 19. Spending about $16 million. Bullish airliners on the affluent consumer, though. You don't want to do it on Spirit Airlines. Although I got JetBlue Airlines just as a lotto play, because I think somebody's going to buy JetBlue. And so far, so good. Then I got a bullish one for you, or a bearish one, perhaps, depending on how you look at it, for the VIX. They bought the 22 calls. The expiration date is November 19, 2025. Spending about $8 million. This is, of course, the November contract, so it's trading at about 20 right now. They're betting for 22. I think they're going to get it. We have volatility pop coming soon. Then we got perhaps a really intelligent, a really good trade here if you're betting for a pullback or a correction in the Qs and the NASDAQ. This is a really interesting way to do it, a short combo. What they're doing is they're selling the 605 calls naked. The expiration date is October 17, 2025. They're using the proceeds to buy the 560 puts for the expiration date of October 17, 2025. All in all, spending about $2.5 million. This is what it looks like. So right now they sold the 605 October 17th, and it means that basically they don't see the Qs trading above 605 by October. They think we're going to go down before that, we're going to correct before that, and the market is already overbought. If it has another insane run to go, it's probably going to stop pretty good before 605. So they're confident to sell that naked, and then they're betting on the correction here, 560, which is a really reasonable target, and they're not overpaying for it, folks, because they're using the short combo to finance it. So it's a really interesting trade. I'm actually thinking about entering this trade beginning tomorrow. Let's do the charts, beginning with the E-mini futures daily chart. What can we see here? We got the 2 hours chart and we have this rising wedge. A little bit of failure here. It was about to break above, but now we got a little bit of a failure, bearish engulfing candle. We'll see. If you zoom out, you have your MACD indicator probably going to roll over. So if we have a bad PPR reading, we could see a revisit back to this lower boundaries of the rising wedge. If we break it and we have a gamma squeeze to the downside, we can go down all the way 6,350. But one step at a time here, folks. We're not going to jump the gun. If you look at the SPY, you would see here again sort of a top at a really elevated MACD and RSI. So if there is an upset by the PPI, I think that we could see somewhat of an inverse ABC to the downside. And then we got to talk about 640. You break that wall, then we can talk about lower targets. But expectations right now, if there is a pullback tomorrow, that's going to be 640. If not, if the PPI is benign, then up we go to 650. The IWM small caps has a mind of its own right now. If the expectations are yields are going to go down and you see the 2-year yield heading down, the IWM will continue to explode higher. But that is dependent on the PPI. If the PPI is hot, maybe we're going to reduce the interest rate cut expectations from 3 to 2, from 3 to 1, from 50 bips to 25 bips. And that could lead the IWM to pull back. So keep that in mind. The dollar is going down, but there is a possibility, again, if there is a hotter PPI, that we could see sort of a falling wedge breakout here. And if the dollar does break out, I expect to see resistance in or around, let's say, 98, 700 basis points. We might see some resistance right here. But a pop like this will cause a lot of assets to move one way or the other. One of the assets that could benefit from a dollar going higher is crude oil, which could be, again, arguably doing its own sort of a falling wedge. We get a hotter PPI and boom, we see crude oil heading higher. Now, I would still expect traders to be a little bearish in crude oil because of the Russia meeting, the Putin meeting. But look, if the dollar goes higher tomorrow, then you're probably going to take a shot on crude oil to go higher that we could see buy the news, sell the rumor. The rumor is right here. Buy the news once we get the meeting between Trump and Putin. Your boy, the old man, though, if there's a pop in the dollar, not going to like it. So it's probably going to end up being such as a bear flag pattern and down we go. I don't expect a big flush, though, but it might be a revisit here to 3,330. It could be. So a lot of you today saying, hey, Mav, do I buy GDX, gold miners? Do I buy SLV? My answer is yes. These assets are always bullish under the circumstances that we got. But for a trade right now, especially if you have a shorter dated trade, your timing has to be precise. So you can't really enter a trade on them until you know how the PPI is going to impact the dollar. Apple, what do we see here? Extended, yes, but it's above the 200 days moving average. And again, yeah, a little bit extended on the RSI, but there is a lot of demand for the 235. So what you could see that Apple outperforms, but Nvidia underperforms. And just knowing how the managers think, folks, if there is a rotation from risk on to risk off, they're going to look at the big caps and say, look, I want to keep my clients at the big caps because that's what's working right now. These are the companies that can buffer inflation and buffer a lot of economic conditions. But I got my Nvidia up 100%. I got Meta up so-and-so. I got Microsoft up insanely for the year. I want to take some profits and rotate to the laggard, which is Apple. So you might see Apple being the best performer of the big caps in the next few weeks or so. And it has been, honestly, because you see Nvidia, if you look at the 2 hours chart, again, could be beginning of sort of a bear flag, and down we go. We got some bad news, but I don't expect a big correction, honestly. Maybe we could see a gamma squeeze to the downside under the right circumstances. If, let's say, the PPI comes out hot, pushes the market down, and then numbers get triggered in the puts in Nvidia, and then the market maker dumps, I think we can go down to 175, maybe 170. But that's maybe it's going to happen next week, not this week. But then we're probably going to have support and wait till that earning report to come out. Souffle Tesla, little bit of weakness, stopping candle, perhaps maybe going to break 333. If we do that, then we're going to initiate a trade for a paid or pay to play. Get paid to play, excuse me. The market maker pays you to play. How do we do that? Because we have the IV ranks really suppressed. If there is a pullback in Tesla that breaks support, we're going to initiate one leg of the puts, wait for it to head down more, then open the other leg. And that way we'll be paid to hold these puts for Tesla all the way to September. Lastly, BTC Tulips, Bitcoin. What do we see here? I think it jumped the gun today because maybe some folks feeling FOMO. Since we have ETH heading higher, BTC not performing, so maybe they stampeded in Bitcoin today. But I say that we have to see what the dollar is going to do in tomorrow's session because of the PPI. And if, again, dollar goes down, it's more of the confirmation that Bitcoin is going to continue to break higher. But what if the dollar rebounds higher because of hotter PPI? Then you're going to see a pullback in Bitcoin. And this is going to be a false breakout. So it pays to wait and see. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We got Thursday the 14th, the initial jobless claims, always important. And then we have PPI, which everybody thinks is not important. I disagree. I think that the PPI could be the surprise. We'll see how it looks. And then, of course, commentary by Fed Zombie from Richmond Barkin. On the earnings calendar, we have Alibaba, AMAT, we have Deere, we have Tapestry, we have JD. We have another company that I'm eyeing a position on, but I need to see how it's going to do tomorrow, which is AMCR. Let's see how it does, because it is a value name, pays a good dividend, but I need to see those results. So we have a lot of interesting stuff to look forward to in tomorrow's session, folks. Let's just leave it right here. I thank you again for joining me in this session. Thank you for listening. Thank you for watching. I appreciate and I love all of you. I'll be talking to you again tomorrow. Good night.
I'll come to your house and drink all your beer. I'll visit your girlfriend in the back bedroom. And you, sir, will take it. Because you have to.